If you believe the Taylor rule, for example, John Taylor from Stanford's algorithm that takes into consideration a lot of environmental factors, his formula says 5%. Right now at an overnight rate at 2.25, there's a big gap. Even if you'd say, you know what, maybe I don't buy the Taylor rule completely, I think it would argue that rates are probably too low in the front end. And then if you look at the intermediate part of the curve, I think the the 10-year rate should be 4.5 and not 3.1.
So Michelle, the market got pretty freaked out, it seems, from the Fed's hawkish comments.
Yeah.
That can't be a good thing if we see wild swings. How do you see this playing out, and what should investors be concerned or not so concerned about?
Yeah, so I agree. Wild swings are not the goal of the Federal Reserve. They're not looking to create volatility and create noise and create dysfunction in the market. But they are looking to tighten financial conditions. They're hiking interest rates, and they're communicating that they have further to go. As Jack said, a lot of the standard models suggest that they actually should be going faster than they are. You have an unemployment rate of 3.7%. You have inflation right around target. They're going very slow and cautiously. So I think what they're trying to achieve is a tightening of financial conditions, gradual move up in rates, and that might come with some sell-off in the stock market, but they're not looking to create disruptions by any means.
So does 5% yield on a 10-year sound realistic or likely to you?
5% is probably a stretch. I think maybe even 4% is a stretch.
Really?
In the near term, certainly. But for now, to see us creep towards 3.5% on the 10-year, I think that's reasonable, and that's consistent with the economic data. And I think that's also probably consistent with what the Fed thinks is normal given the hiking cycle.
Given that, Jack,
yeah.
I mean, if you really believe you're headed, say, to 3, 5, or 4, I mean, does that mean that autos and housing look unpalatable for, I don't know, the near future? I mean, when does that possibly get interesting?
Yeah, no, I think that the catalyst for this move is going to be the European Central Bank ending its quantitative easing program at the end of this year. They've already gone on record to say that. It's been the European rates, the German Bund, which was for a long time was below 0.5%. The 10-year Bund was keeping a tether on the U.S. rate. So now getting them out of the quantitative easing business is going to start really putting upward pressure on the intermediate part of the curve. Essentially, the way I see it is the water in which all of these markets are swimming in is going to get colder, and it's going to impact those markets that are more highly valued, have a higher valuation, like U.S. and U.S. growth, than it will probably Europe, UK, Japan, and even the emerging markets, because those rates are going to go up also.